In the year 2023, 57 IPOs got listed on Dalal Street and they raised a total of 50,000 crore rupees. Many of those IPOs saw big listing gains and retail investors made good money because retail participation was high. The year 2024 might get even bigger because unlisted companies are targeting to raise 1 lakh crore rupees via IPOs, which is double the money raised in 2023. So today we are going to have a look at 5 big and well-known companies which are ready to get listed on the stock market. And we are going to find out if these companies will be any good for retail investors. And let me tell you in advance that one of these IPOs is already looking a bit embarrassing to me. Namaste and welcome to Retail Investing. Company number 1 is Ola Electric and it is a subsidiary of Ola, which we all know is a taxi ride-sharing company. So Ola Electric is planning to raise $700 to $800 million via this IPO at a valuation of under $8 billion, which is over 66,000 crore rupees. Can the company's financials justify that valuation? Let's find out. So here is the profit and loss statement from the DHRP filed by Ola Electric. All figures are in millions, which means we divide them by 10 to get in crores. In financial year 2021, revenues are only 0.8 crores. And in the first quarter of financial year 2023, revenues were 1242 crores. If in all the quarters of the year, Ola Electric can hit these numbers, their revenues will touch almost 5,000 crore rupees for the financial year. The loss percentage also came down massively from 2022. That is nice, but please note that the company is under heavy debt. As you can see, the long-term debt on the balance sheet is more than 700 crore rupees and the short-term debt is 900 plus crore rupees. So a valuation of 66,000 crore rupees for a company whose estimated annual loss is 1,000 crore rupees. Is that justified? Please let me know in the comment section. Now, I would like to stay away from investing in electric two-wheeler companies because the competition is going to be out of proportion and nobody will have any business moat. If the market is in a good mood, almost every IPO gets listing gains and promoters try to bring their IPOs only when the market is in a good mood. So good luck with Ola Electric. Company number 2 that is eagerly waiting to get listed on the stock market is Oracle Stays Limited, popularly known as OYO, and the company operates in the hospitality sector. This IPO has been delayed for a long time. They have been trying since 2022. So this is the profit and loss statement from the DHRP filed by OYO in 2022. As you can see, for the financial year 2021, the company's losses were almost 4,000 crore rupees. On top of that, they had huge debt on their balance sheet and there were issues with the company's valuations. Hence, the IPO did not happen. In March 2023, they resubmitted the DHRP to SEBI in a confidential manner and all the data is not available in the public domain yet. Now that the information that is available in the public domain is that the company is having issues with debt. In fact, they are raising money from the public through this IPO to repay their previous debt. Let me introduce you to a concept called TLB, which is short for Term Loan B. So what happens in a Term Loan B is that the borrower does not start paying back the principal from the beginning. So initially the installment payments are very small and for that reason near the end of the loan they have to pay back a huge amount. So when companies raise money via Term Loan B, their future cash flows are reserved for their creditors and not for investors like you and me. OYO became the first Indian internet company to raise money through Term Loan B and they used the money to pay back previous loans. And now they want to raise money through this IPO to pay back the debt they raised from the Term Loan B. It looks like a struggling debt-ridden company. I am definitely out. Company number 3 is from the industry of online food ordering and delivering. It is the largest competitor of Zomato. And you guessed it right, it's Swiggy. So Swiggy is an online platform where people discover restaurants, order food and get it delivered to their homes. Subscriptions, advertisements and commissions from restaurants are the sources of revenues for the company. As of now, Swiggy's plans are to file the DHRP with SEBI in March 2024 and get listed on the stock market in July-August. So there is time for this IPO, but it is better to understand the valuations in advance. In January 2022, Swiggy had a fundraising round in which they raised $700 million at a valuation of $10 billion. That was a very high valuation, but recently an investment management company known as Invesco has valued Swiggy at $5.5 billion. But does Swiggy make any profits? According to the investment management company Prosus, which owns 33% of Swiggy, the company's losses went up 80% in financial year 2023. The revenues are $900 million and the losses are $545 million. Swiggy also has a quick commerce business known as Instamart, and that is the source of the huge losses. I don't know what the profit and loss figures will look like in July-August when the IPO happens, but a valuation of $5.5 billion for a company which is $500 million in losses does not make sense to me. Company number 4 handles our demat accounts, and it is National Securities Depository Limited, in short NSDL. NSDL earns their revenues by opening demat accounts, charging for transactions in our demat accounts, charging annual fees for maintenance of demat accounts, and they also charge companies who bring their IPOs. Not sure if they are going to pay themselves for their own IPO. As the name suggests, the company provides deposit services for our demat accounts, just like banks provide deposit services for our money. There are only 2 players in the market, NSDL and CDSL. The brokers like Zerodha and Grow are called depository participants, and these depository participants actually act as agents of NSDL and CDSL. We retail investors cannot avail services directly from NSDL or CDSL. We have to get them through Zerodha and Grow. As of now, only 3% Indians invest in the stock market. If you compare that with an advanced economy like the USA, 50% of the population invest in the stock market there. The revenue model of NSDL makes it clear that as more and more people join the stock market, the company's revenues and profits will go up. The positive thing is that a stock market participation of only 3% is too low and big growth is on the cards. But the question is how much of that growth can translate into profits for companies like NSDL and CDSL. Some people like to call these businesses monopoly/duopoly businesses. But these companies lack the defining trait of a monopoly business, which is pricing power. If there is high demand for a product or service and there is only one seller, the seller decides the price and that makes him rich. But in case of NSDL and CDSL, the fees are kind of fixed and the government won't allow fee hikes. So as per my understanding, these companies are monopolies in name only. But they can definitely give very good returns to investors during bull markets. So here is the chart of CDSL. The company got listed in 2017 at around 250 rupees, and the stock market did pretty well in the next 3 to 4 years. And without any surprise, CDSL went up from 250 rupees to levels of 1500 to 1600. That's an easy 6x returns in just 4 years. Can NSDL give similar returns in the next 4 years? Here is a small comparison of the two companies. As on March 2023, CDSL had 8.3 crore active demat accounts. NSDL had only 3.15 crore active demat accounts. But the custody value in respect of demat accounts for NSDL was more than 300 lakh crore rupees. But for CDSL, this number is only 40 lakh crore rupees. And all the transactions of the foreign institutional investors are handled by NSDL. CDSL has no share in that. So it looks like NSDL is going to be a good IPO for retail investors if the markets remain bullish. And for optimal returns, investors should consider staying invested for a few years' time. And company number 5 is the embarrassing one. It is from the EdTech sector, and it is BYJUS. The company is in a problematic financial situation with huge losses. Their revenues went from 1300 crores in financial year 2019 to 2280 crores in financial year 2021. But at what cost? A consolidated loss of 4588 crore rupees. And still, BYJUS made 9 acquisitions in 2022. The release of financial statements for the financial year 2022 was delayed, due to which their auditor resigned in 2022. And the founder said 2022 was an uniquely belligerent year, and acquiring 9 companies will give him lifelong learnings. Common sense tells us that companies should be acquired for earnings, not for learnings. This is not the way to play with investors' money. BYJUS was once valued at $22 billion. But now it has been reduced to $5 billion. You see, when the captain of the ship is confused and lacks clarity, it is a big red flag. So I am definitely out of this IPO. These were just 5 big and well-known companies which are planning to bring their IPOs in 2024. According to some industry experts, companies are planning to raise more than 1 lakh crore rupees via IPOs in 2024. This means we could see twice as many IPOs this year compared to the previous year. So what does that tell us about the market outlook for the year? Well, companies always bring their IPOs in bullish markets, and they clearly expect 2024 to be dominated by the bulls. Don't forget to type in the comment section which big IPOs you are targeting this year. Thank you for joining, and I'll see you soon. Jai Hind.